Here we have a series of lower lows and lower highs, and an extreme area of the supply zone. Now, why is this supply area so important? Because it created a bearish imbalance and a break of structure. So, our bias is bearish. And if the price returns to this area, we can take short entries, and our first target would be this low. Now, here we can see that the price has failed to create a new low, and it has broken the supply zone to the upside, which shows that the demand has taken control. Now, our bias is bullish, and we can take long entries at demand levels until we reach the unmitigated supply area in front of the price. After tapping into that zone, we have no clear bias, and we should wait to find out which side can take control again. All of our explanations were on a single time frame so far, but usually we apply this concept across multiple time frames. For example, this demand zone could have been a key level on a higher time frame. Anytime you want to determine the bias, you need to analyze from a higher time frame down to a lower time frame. An important point to note is that, as you zoom into lower time frames, you're likely to encounter many false price action signals due to higher volatility. That's why it's crucial to base your analysis primarily on the daily and 4-hour time frames. This is also why trading price action setups tend to have higher win rates on the hourly time frame compared to the 1 minute, as lower time frames carry more noise. Now, with all that being said, to identify the daily bias, we open the daily and 4-hour charts and apply this concept to determine who is in control. Then, we zoom into our entry time frame and search for trading opportunities aligned with the higher time frame bias. Now, the next concept to apply to the chart to establish a high-quality method for determining daily bias is the liquidity concept. You might have heard that liquidity is what makes the price move. But where is this liquidity? It's not just found above the swing highs or swing lows. At every price level, there's a lot of liquidity available. However, what we're talking about here is stop-loss liquidity. Liquidity exists where stop-losses are located.
This are scammers impersonating my account.
There are two types of liquidity in the market: buy-side and sell-side. Liquidity above a high or a group of highs represents buy-side liquidity. Liquidity below a low or a group of lows represents sell-side liquidity. Now, how does it help in terms of identifying market bias? To answer this question, you need to know how the algorithmic price delivery works. The algorithmic price delivery is engineered market behavior by big banks and institutions to make the market fluctuations towards the liquidity zones on the chart. The price is always coming from a liquidity zone or moving towards it, liquidity to grab and liquidity to target.
How the automated system works and its trading results.
When the price approaches buy-side liquidity, the bearish traders will go short, or they will protect their previously opened short positions. On the other hand, the breakout traders will go long if the price breaks through this level. The animated movement that aimed to grab this liquidity is called the buy-side delivery. It's running high to engage the liquidity above these relative equal highs. The algorithmic price delivery has engaged the liquidity by trapping traders on both sides, and then the smart money would go short. When the price approaches this level, the bullish traders will go long, or they will protect their previously opened long positions. On the other hand, the breakout traders will go short if the price breaks through this level. The animated movement that aimed to grab this liquidity is called the sell-side delivery. The algorithmic price delivery has engaged the liquidity by trapping traders on both sides, and then the smart money would go long to engage the buy-side liquidity. Now, this general analysis is aimed at finding the overall market direction, but not entry setups. You can use any strategy to enter the trading position,